Most people don't lose money because they're irresponsible. They lose money because they feel responsible. They budget. They invest. They buy index funds. They listen to podcasts. They think they're doing everything correctly. And yet, somehow their net worth barely moves. That's the trap. Because the biggest financial losses rarely look dangerous in real time. They look normal. A few bad decisions, a few delayed moves, a few safe habits. And suddenly you realize you didn't lose $500. You lost 10 years. Here's a simple example. If you invested an extra $800 per month into quality assets, earning long-term market returns, over time that gap becomes hundreds of thousands of dollars. Not because of intelligence, because of behavior. And that's what this video is really about. Not obvious financial mistakes. Hidden ones. The blind spots that quietly drain $10,000 or more from investors every single year while they still believe they're financially competent. So let's start with the first one, because this is where most people begin losing long-term wealth without realizing it. Blind spot, or 10. Confusing income with progress. A high income creates confidence, but confidence is not the same as financial progress. That's where people go wrong. Someone earning $180,000 per year can still be financially fragile. Why? Because income hides inefficiency. A person making $60,000 notices every mistake. A person making $250,000 often doesn't. The leaks become invisible. Higher rent, more subscriptions, lifestyle inflation, expensive convenience, luxury, rewards, and slowly, their increased income gets absorbed into maintenance, not wealth creation. Sounds successful, right? Not exactly. Because real wealth is not built from how much enters your life. It's built from how much survives it. That's the difference. A doctor making huge income, but investing inconsistently can lose to an engineer quietly. Compounding index funds for 15 years. Not because the engineer is smarter, because systems beat ego. And here's the psychological trap. People emotionally upgrade their identity before upgrading their balance sheet. The nicer apartment becomes proof they've made it. The expensive car becomes emotional validation. The lifestyle becomes the reward before freedom is achieved. But lifestyle has a hidden tax, maintenance. Once your life expands, it becomes harder to reduce. Now your income must feed the machine you created, which leads to the next problem. Because once people normalize higher spending, they start believing they can catch up later. That's where the damage accelerates. Blind spot number 9. Delaying investing while waiting to feel ready. Most investors think the biggest risk is losing money. It's not. The biggest risk is waiting. Waiting to understand more. Waiting for markets to calm down. Waiting for higher income. Waiting for certainty. But investing rewards time more than intelligence. And the market doesn't care when you finally feel emotionally prepared. Here's the painful part. People obsess over finding the perfect investment, while losing years of compounding. Someone investing imperfectly for 10 years often beats someone who spent 5 years researching. That sounds unfair, because it is. Compounding is brutally biased toward early action. A delayed start doesn't just cost money, it destroys momentum. And psychologically, delay feels productive. Watching finance videos feels productive. Reading threads feels productive. Planning feels productive. But there's a dangerous illusion here. Consumption feels like participation. It isn't. You're not building wealth by studying wealth forever. At some point, information becomes procrastination wearing a suit. And here's where it gets deeper. The longer people wait, the more emotionally significant investing becomes. Now every decision feels bigger, riskier, heavier, which creates more hesitation. And hesitation compounds too. That leads directly into another expensive blind spot, one that looks smart on the surface. Blind spot number 8. Mistaking activity for intelligence. A lot of investors are addicted to movement, constant portfolio adjustments, constant news, constant reactions, buying, selling, rotating, optimizing. It feels intelligent. It feels active. But most of the time, it's emotional noise disguised as strategy. Long-term wealth is usually boring. That's the uncomfortable truth. Most fortunes are built through repetition, patience, and consistency, not constant tactical brilliance. But modern investing culture rewards stimulation. Apps update every second. Markets flash red and green. Financial media turns daily fluctuations into emergencies. So investors begin feeling pressure to do something, even when doing nothing would outperform. That's the trap, because every unnecessary trade has a cost. Taxes, fees, spread losses, bad timing, emotional decisions. And those small mistakes stack quietly for years. But the deeper issue is identity. Some people don't want wealth. They want the feeling of being financially sophisticated. There's a difference. Sophistication feels exciting. Wealth creation often feels repetitive. One stimulates ego, the other compounds capital. And eventually investors reach a dangerous point. They become over-involved in short-term movement, while under-invested in long-term direction. Which brings us to something even more expensive. A blind spot hiding inside safe financial behavior. Blind spot number 7, holding too much cash for too long. People love the feeling of safety. Cash feels safe. Watching your bank account grow feels safe. But inflation punishes emotional comfort, quietly, relentlessly. Every year your idle cash loses purchasing power. Not dramatically, not emotionally, silently. And silent losses are the most dangerous losses because nobody reacts to them. If inflation averages even a few percent annually, large cash positions slowly decay, while investors convince themselves they're being responsible. Now obviously emergency funds matter. Liquidity matters. But many investors aren't holding emergency cash. They're hiding from uncertainty. That's different, because cash often becomes emotional avoidance. I'll invest when markets settle. I'll wait for a better opportunity. I'm being cautious. But years pass, and the opportunity cost becomes enormous, especially during strong market recoveries. Some investors miss entire bull markets waiting for crashes that never arrive. And here's the uncomfortable part. People think avoiding volatility protects them from pain. But avoiding growth creates another kind of pain. Falling behind. Watching inflation rise. Watching assets rise. Watching life get more expensive. While your money stands still, you're not preserving wealth. You're slowly shrinking it. And now we reach something deeper. Because eventually this stops being about money entirely. You thought this was about investing. It's not. It's about behavior. Most financial blind spots are not mathematical errors. They're emotional patterns. Fear disguised as caution. Ego disguised as confidence. Consumption disguised as success. That's why intelligent people still struggle financially. Knowledge alone doesn't change outcomes. Identity does. Because wealth creation requires behaviors that often feel uncomfortable in the short term. Patience, delayed gratification, consistency, long-term thinking. And modern culture trains the opposite. Immediate stimulation, immediate status, immediate comfort. So the real battle isn't against the market. It's against the version of yourself that wants short-term emotional relief. And now the blind spots become more dangerous. Because from this point forward, the costs become harder to reverse. Blind spot number 6, ignoring opportunity cost. This is one of the most expensive concepts in finance. And most people barely think about it. Opportunity cost is not just what you spend. It's what that money could have become. That changes everything. A $4,000 luxury purchase isn't just $4,000. Over decades, invested properly, it could become far more. And this applies everywhere. Unused subscriptions, overpriced cars, high-interest debt, lifestyle upgrades. The real damage isn't the transaction. It's the future you sacrifice for temporary satisfaction. But here's why people ignore opportunity cost. The future is invisible. You don't emotionally feel loss compounding. You only feel immediate pleasure. That's why long-term thinking is so rare. Humans naturally prioritize present comfort over future expansion, which is exactly why wealth inequality widens over time. Some people convert income into future assets. Others convert income into temporary experiences. One compounds freedom. The other compounds dependency. And here's where investors sabotage themselves. They treat investing as an extra expense, instead of treating spending as the thing competing against future freedom. That mental shift matters a lot. Because once you see every dollar as an employee, you stop wasting them on things that produce nothing. And that leads to another blind spot that destroys enormous amounts of money over time. Blind spot number 5, underestimating small recurring losses. People ignore small financial leaks because they feel insignificant. But wealth destruction is usually repetitive, not dramatic. A bad financial habit repeated for 10 years becomes catastrophic. High fees, poor interest rates, lifestyle creep, impulse spending, constant upgrades. Individually, they seem harmless. Collectively, they become wealth erosion systems. Here's the problem. Humans react emotionally to large losses. But recurring small losses bypass emotional alarms. That's why subscription businesses are so powerful. That's why credit card debt becomes permanent. That's why lifestyle inflation feels invisible. Nothing feels painful enough to trigger change. So the cycle continues, and investors often underestimate how fragile compounding actually is. Small percentage differences create massive long-term gaps. A slightly higher fee, a slightly worse return, a slightly delayed start. Over decades, the outcome changes dramatically. But here's the deeper issue. People often believe financial freedom will come from one big breakthrough, a huge stock, a massive raise, a lucky investment. Meanwhile, their daily systems quietly destroy consistency. That's the contradiction. The future is usually decided by repeated patterns, not isolated moments. And this is where things start becoming psychologically dangerous. Because eventually people stop trying to build wealth. They start trying to appear wealthy. Blind spot number 4, performing wealth instead of building it. This one destroys more investors than people realize, especially in high-income environments. People begin treating money as identity theater. The watch, the luxury apartment, the expensive dinners, the successful lifestyle. Everything becomes visual, and social media makes this worse. Because now financial success is constantly performed in public. But performance creates pressure. Pressure creates overspending. Overspending destroys investing capacity. That's the cycle. And here's the uncomfortable truth. A lot of people don't actually want freedom. They want social proof. Because social proof gives immediate emotional rewards. Freedom does not. Freedom looks boring for a long time. Quiet investing, quiet saving, quiet discipline, no applause, no validation, no visible excitement, which means many investors unconsciously sabotage long-term wealth for short-term identity reinforcement. And eventually something dangerous happens. Their lifestyle becomes too expensive to sustain without constant income. Now they're trapped. High income, low freedom. That's not wealth. That's dependency with premium branding. And this leads directly into one of the biggest blind spots in modern investing culture, a blind spot disguised as ambition. Blind spot number 3, chasing complexity instead of consistency. People assume complicated strategies create superior outcomes. Sometimes they do. Most of the time, they create distraction. Complexity feels intelligent. Consistency feels boring. That's why investors constantly search for better systems instead of following simple, effective ones long enough to benefit. New strategies, new indicators, new assets, new trends. Always searching, always optimizing. But constantly changing direction destroys compounding. Imagine planting a tree, then digging it up every month to check if it's growing. That's how many investors behave, and financial media profits from this behavior. Because calm consistency is difficult to monetize. Urgency is easier, fear is easier. Constant change is easier. So investors become trapped in endless tactical consumption instead of strategic execution. And psychologically, complexity provides emotional comfort. If something is complicated, people assume it must be valuable. But wealth creation is often painfully simple. Earn, invest, hold, repeat. The difficulty is not understanding it. The difficulty is tolerating the boredom required to continue. Which brings us to something darker, because some investors eventually stop thinking long-term altogether. Blind spot number 2, optimizing for lifestyle instead of freedom. This is where financial ambition quietly collapses. People start making decisions based on comfort optimization instead of freedom optimization. That sounds subtle, but it changes everything. They choose higher monthly obligations, higher recurring expenses, more convenience dependency. Life becomes smoother, but financially heavier. And eventually their entire income becomes allocated before it even arrives. That's the modern trap. People increase income, then immediately increase fixed costs. So despite earning more, they never gain leverage. Only maintenance, and maintenance is exhausting. Because now every financial decision carries pressure. You can't walk away from bad jobs. You can't take intelligent risks. You can't survive uncertainty comfortably. Your lifestyle owns you. That's the hidden cost nobody talks about. A financially heavy life removes optionality. And optionality is one of the most valuable forms of wealth. The ability to wait, the ability to pivot, the ability to say no. Without that, you're not investing from strength. You're investing from survival pressure. And survival pressure creates terrible decisions, which leads to the final blind spot, the one underneath almost all the others. Blind spot number 1, believing financial competence equals financial security. This is the most dangerous illusion of all, because knowledge creates false certainty. People understand investing basics. They know about ETFs. They know about diversification. They know debt matters. And because they know these things, they assume they're financially safe. But awareness without execution changes nothing. You can understand wealth deeply while still living in fragile systems. That's the collapse. Financial intelligence often becomes intellectual, entertainment instead of behavioral transformation. People consume finance content for years without materially changing their actions. And eventually they build a dangerous identity. I'm financially smart. Meanwhile, they don't invest enough. They overspend emotionally. They delay hard decisions. They normalize inefficiency. The blind spot isn't ignorance anymore. It's self-deception. And self-deception is expensive. Because once people believe they're already financially competent, they stop examining themselves critically. That's when stagnation begins. Not with failure. With comfort. And here's the reality most investors eventually discover too late. Wealth is not built from isolated smart decisions. It's built from sustained alignment between behavior and long-term priorities. That's harder than people think, because markets are not the biggest challenge. Human psychology is. Most people think financial failure looks dramatic. It doesn't. Usually it looks normal. A normal car payment, a normal spending habit, a normal delay, a normal lifestyle. That's why these blind spots are dangerous, because they don't feel destructive while they're happening. Until one day you realize, you earned good money, you worked hard, you invested sometimes, and yet freedom still feels far away. Not because you were reckless, because you were slightly misaligned for years, and small misalignment compounds. That's the real lesson. Wealth is rarely destroyed by one catastrophic mistake. It's destroyed by repeated invisible ones. But this still isn't the biggest financial trap people fall into, because the next mistake doesn't just slow wealth creation. It actively sabotages your net worth every single month, while convincing you it's helping you. And that's exactly what we're breaking down in the next video. Top 10 credit card mistakes that sabotage your net worth.